really bad companies, and that's one thing you kind of have to sift through. So what I would do, if I got up here, let's see, we had, I don't want to use that one. Let's bring Marathon back up here. You know, you guys have a lot of companies. Some sectors, like industrials and discretionary and financials, have a ton of companies. So you can't really go through all of them. So I would start where, certainly, you know, sort by how much they're undervalued. I would start with those that are most undervalued and give them just a quick glance. So what would I suggest going and looking at first? One thing is I'd get their cost of capital. Ethan, you're going to be the one that's going to have a hard time with. You've already seen that issue.
I mean, I know the WAC was the one I shouldn't be using. The
Well, you wouldn't even find
I'd have to use
a cost of equity.
Yeah.
So,
okay.
we'll think about yours in a minute.
Yeah.
All right, there's a solution to that.
Okay.
But get the WAC. So Marathon, 6.1%, and then let's go real quick and find the ROIC on them, and just make a quick comparison. And the return on invested capital, 18.48. In fact, it's been, now their average has been 6 2/3, but it's 18.4. So now that's what, December 23? I want to get more recent data, so let's go use the quarters here. Okay, so where are they now? 9.34. So they're still above their cost of capital, right? So that means investment for them should increase value for Marathon. That's one thing I want to look at. Now, that's not going to be the case for all of you, especially if you have younger growing companies. Keep that in mind. But if they're not earning their cost of capital and they're young growing companies, eventually they'll run out of capital, right? They'll destroy value. So at some point, there's got to be a turnaround where they start generating excess profit, returns above their cost of capital, so that growth starts to pay off. So if you guys find a company that you want to recommend that is growing and their return on capital is less than their cost of capital, and you really want to recommend them, then I would suspect you point that out, and you also say what's led you to believe they're going to turn that around, right? Or what the company has stated that gives you confidence that they will do so. What if you have an old mature company that's doing that? Then you need to look and see if it looks like it's just an aberration, right? It's just an anomaly, and you don't expect that to continue. That could happen. But if it's an old company and they're not earning their cost of capital, it looks like it's persistent, and they're, you know, they may be heading for decline. So keep that in mind. Okay, so that's the first thing I might look at. Ethan, if I'm in your sector, since I can't get that WAC, what I need to do is get their beta, and you get that off the screen,
Yes.
right? The 5-year beta,
Yes.
and then you're going to do this. You're simply going to go to get the, wherever it is, ten-year treasury, 4.432. There's your risk-free rate.
Yes. And then okay, interesting.
Right. And then go back in the fact set and type in some other firm that's not a financial, like Marathon, and click on that WAC. And once it opens up, go to cost of equity and get market risk premium 4.12. And just compute your CAPM return and compare that to the ROE.
Okay.
Right? So you'll do it based on equity instead of operating profit. All right, so that's the first thing. See if the returns are earning meet or exceed the cost of earning those returns. Then the next thing I'd suggest you guys do, just a quick perusal, go to the cash flow statement, like we talked about before, right? So go there. We kind of talked about this before. Most of you will have mature or maturing companies. So that being the case, I would expect to see net operating cash flow, the top section of the cash flow statement, to be positive. I hope it's been increasing over time, but I certainly would like to see it positive. Now remember, we talked about the adjustments to get a little bit different version of free cash flow than what FactSet computes. For example, Marathon has had some acquisitions, and FactSet doesn't include that in their cash flow, but we want to include that in there, so it's going to reduce it somewhat. So I want to see if the free cash flow is positive and what's happening there. And then you also kind of want to do this. What are these at free cash flow for? I know there's 5 things, right? They can, for shareholders, they can do stock buybacks and dividends. For creditors, they can pay off debt or pay interest on debt, and then they can build up non-operating assets. The biggest things is they need to cover their debt, and they also want to take care of shareholders. And for shareholders, let's see what Marathon's been doing. Tons of, well, let's see. Let's go back to fiscal years here. Okay, so they've had, like oil and gas has had, some kind of erratic operating cash flow, but they've kept it positive. I'm kind of ignoring the M&A for right now. Their free cash flow is a little bit erratic, but except for a year, they've been positive. And let's see, what have they done? They've been paying dividends. They haven't regularly increased them, but they've been paying steady dividends. They've also been doing buybacks for a lot of years. But if you look at this, look at their cash flow, $5.3 billion. Look what they've done up here. A little bit over $1.8 billion in dividends, $10.3 billion in stock buybacks. So how can they afford to do that? They're drawing down cash, right? So be aware of that. Marathon, the past this year to date and last year, drew down $7.5 billion in cash because they paid out more than what they were bringing in. So that means that can't continue. That's unsustainable, right? So that's not sustainable for them to do that.
So on their balance sheet, their cash would be decreasing?
Yeah.
Okay.
Or remember that sustainable growth rate thing we've talked about
right.
before. There's other ways to manipulate it, right? That had some assumptions about not changing capital structure and stuff like that. Cash could be going up. So like, how could they draw down cash and it goes up? They could be borrowing a ton of money, things like that. But kind of keep in mind, when you look at that, compare it to what they've been paying out, right? Remember, stock repurchases aren't usually considered to be something that investors rely on year after year. But dividends are, right? And they also need to pay their creditors. So I look at the cash flow statement. There's several things you can tell about a company by looking at the cash flow statement. And then you could look at some ratios. We'll go back, we did some ratios last Thursday. We'll go back and look at them some more today. But probably the next thing I do is where I showed you guys that DCS screen, the credit analysis. I would make that my next stop, just to get a cursory view of the company. And the reason why is this. Let's bring it up here. We talked about Standard & Poor's, so their credit rating, whether it's stable or not, and the possible direction on it. Standard & Poor's does all this ratio analysis and all other kinds of analysis on that company and its debt before they post that rating, before they declare whether it's stable or not and what the outlook is. So by looking at that early, you are bringing in a full set of financial analysis just by looking at that, right? Because that's what they've done. We looked at this credit default swaps, right? Looked at those spreads. So that's the market making an assessment of Marathon based upon what they've seen. And remember, these are people who've actually bought these swaps or sold them. So so you would presume they've done fairly thorough analysis and not just making off the cuff bets. So they've done what S&P's done, except while S&P's gotten paid for their service, whoever's bought these things are putting their money out there at risk, right? So they really need to get their analysis right. So, the 5-year, the 1 year, we can see the 5-year spread has increased since summer, but it's fallen off lately. So you could say recently in the past, maybe the past week or two, the market's assessed that the credit risk for Marathon has reduced itself a little bit. Maybe it's something to do with Marathon, maybe it's the overall sector or the economy, we don't know, but they've assessed a little bit less credit risk.
But in the past 5 years, it's risen.
Yeah, or actually not in the past 5 years. This is a 5-year swap,
Yeah.
but it's over since, say, the end of May or the beginning of June.
Could you explain what each of those lines is meaning?
So the blue line is their stock price. Right.
Okay.
So we can see what's happened to Marathon over the past 6 months or so. This kind of greenish line that's the 1-year credit default swap. So remember, a credit default swap, is like an insurance contract.
Mm-hmm.
The buyer would be equivalent to one of you guys with your car insurance, right? You pay a premium to the insurance company. And then while in the car insurance, you hope you don't have an accident where you need to go and file a claim. If there's an accident, you file a claim, you get paid money, right? Here, you kind of hope there's that accident because the accident is the company defaults. And if so you're making a bet the company will default when you buy a credit default swap. When you buy a 1-year CDS, you're making a bet that the company will default within that year. When you buy a 5-year, you're making the bet they'll default within 5 years. Now you notice that the 5 year is always going to be above the 1 year because whoever's selling you this thing realizes 5 years is more time for it to work in your favor. So they're going to charge you a higher premium, right? A higher payment to give you that bet for 5 solid years. Right, so that's what those 3 lines are right there.
So over the past week, the risk of the company defaulting, according to swap analysis, is less.
Exactly.
Okay.
Or put differently, the market has assessed that this company now has slightly less credit risk than it did a week or 2 ago.
Okay.
Right? Whereas Standard & Poor's is a company that's done its analysis. So not the market, but simply a bunch of analysts at the company.
Okay, that makes
Right?
sense.
And then you've got this Z-score down here at the bottom, right, that we talked about as well. So I'd give a quick perusal to those. And I'd look over here at this chart. Are there big spikes of debt coming up pretty soon that we need to be aware of and worry about? Don't worry about the spike. You're almost always going to see this out here. That's everything more than 10 years out. So don't worry about that. If you see a spike out here, don't even worry about it. It won't even register, okay? By the way, if companies do have a lot of stuff along here, what's the implication?
Had to pay a lot of that over those time periods.
They got to pay it off. But what if I said that's probably not going to happen and they're not going to default? What's going on?
They're not going to pay it off. But they're not gonna
A bond?
Hmm?
Is it a bond?
Yeah, so these could be bank loans, bonds, any of that. It's outstanding debt coming due on those years.
But they're
So
not-
in 2025, or let's see, for this year, they've got $1.15 billion in notes and bonds coming due this year in Marathon.
We're just going to borrow.
Do they have a
and then
sinking fund?
repay it.
They borrow again and use the new debt
To pay
to
it.
roll over or pay off the old debt.
Okay.
That's very, very common
That's what the
that
US
firms
does.
do that. What's been happening, what's happening to interest rates?
They've been going
2%.
down. Well, I mean, they've been going up.
Not all, right? So it
But-
depends on the part of the yield curve we're on,
Mm-hmm.
right? So if they have a lot of debt that looks like it's coming due, it's not necessarily do they have the money to pay it off, it is what's going to happen to their interest expense when they roll the debt over and refinance it with new debt to pay off the old debt.
Do you usually get higher interest rates when they do that? I would assume they
Well,
do.
it depends. We have to remember you were seeing that mortgage rates have been going up, right?
Yeah.
And they've been keyed to the 10-year Treasury, which has definitely gone up
Yeah.
about 50 basis points since the Fed lowered rates
Yeah.
about 2 months ago, right?
Yeah.
So
They lowered rates again last week.
yeah, so maybe rates. So
Yeah.
Another
the
25.
Treasury's been going up even more since then. Yeah.
Is that
but-
basically what NRG did a couple weeks ago?
Yeah. So kind of dig around. You know, do they have a?
Oh yeah, mortgage rates went back up.
Yeah, and then some years still going up.
We're back at 6.80%.
Good times.
Yeah, I would say for a lot of it, I was about to look around in there and see about finding their average maturity of their debt. But I think for most of you, I would simply compare short-term debt to 1-year treasuries and long-term debt to the 10-year treasury. And if the 10-year treasury is going up, then firms are going to be paying a higher rate on long-term debt and they refinance it. If it's short-term debt, so revolving lines of credit, things like that, those would be key to short-term treasuries plus a credit spread. So if the short-term treasuries are going down, then those rates might go down. Okay? Let's see. Let's go at some of the ratios real quick. Let's do this also. All right, so those are the things. No. Those are the things I'd be looking at first off on there. And I think from just looking at those few things, you can get a pretty quick assessment if like something that seemed undervalued is probably junk and cast it aside. Right? It's like I don't like what I'm seeing. The cash flows are awful. The returns are below the cost of capital. The credit analysis they look really bad. I would be uncomfortable having them in the portfolio. You can pick a lot of those out pretty quick, right? If you're a little bit uncertain from what you're seeing, then that means a bit more in-depth analysis would be due after that. Yeah, so in that case, if you've got a company that seems to be where it needs a bit more work, then I'd start looking at more of this stuff here, right? So look at your profit margins, see what they are now to what they have been on average and how they stack up against the industry. Look at some of your asset management ratios, at a minimum asset turnover. Again, where is it now? What's its average been? What about its peer group, the industry? Current ratio for liquidity, debt to capital for financial leverage, use of debt. Let's see. A couple of things I don't have on here that might be worth mentioning real quick. If you guys have a manufacturing firm, or maybe you've got a retail firm, so think Crocs, for example, right? Or a manufacturing firm, Caterpillar. So let's see. In fact, let's look at Crocs real quick. In addition to like those kind of those few ratios I had on that page. And by the way, I posted that to D12 for you guys. So let's look at something with Crocs real quick. Let's go to the ratios. Or actually, let's go to key items, I think. And let's go back to okay. So if you want to do a little bit deeper dive in them, the first place to start might well be looking at this DuPont analysis of ROE. Because remember, it's splitting up ROE, return on equity, so net income to shareholder equity, into pieces that derive it. So, for example, your profit margins. So this is Crocs. I did it annual, so I don't have we want to do fiscal quarters to get the most recent, but let's start out with annual in here. So if you go back and look at pre-pandemic to post, look what's happened to their profit margins. Below 10%, and they've been up in the 20s since then. But they have, in the past couple of years, you could say, declined a little bit in profitability, right? The second part of DuPont ROE is asset turnover. So where are you? Up here at the very top. So sales to assets, I'd rather see that number higher than lower, right? More sales for every dollar of asset. And when did they make the Hey Dudes acquisition, Laura? Remember? 21. And look what's happened to their asset turnover since then. It's been dropping off fairly by more than 50%, right? Or roughly 50%, which is pretty steep. In fact, they were even better back here. So that's a measure of efficiency, right? Or productivity. A low turnover ratio, they're not really extracting what they need to out of their assets in terms of revenue. How does that hurt them? They could have a lot of idle assets they've paid for, they're not doing anything. Alternatively, it means if they're growing, Crocs is still growing, then if they grew, but they're only that efficient now, then, well, let's put it this way. What if back here they were to have doubled sales? Then they could support $2 sales for every dollar of assets. They'd only have to grow assets for about 50% to support doubling of sales. What if they doubled sales now, and that's their asset turnover ratio? They need more than to double their assets. So it's going to be a lot more expensive for them to grow with these lower asset turnover ratios. So that's the implication here. It's not just can they get more assets out of it. The lower the ratio, the more expensive it is to push further growth out. Okay. Though, let's say, one thing I want to show you guys is you want to go dig around in the most recent annual report, so the 10K. So if I saw something like that, and I saw like the asset management or the asset turnover ratio was declining, I'd want to see what they say about it. So you might do a word search, asset turnover, or excess capacity, because I'm kind of concerned they could have a lot of excess capacity, so they've got room to grow without adding more assets. That's a possibility. So I want to see what management has to say about that. Let's see, asset turnover, profit margin. That's going to give us ROA, and we've got the multiplier assets to equity. This is from using debt, right? So for every dollar of equity, however many, so right here, 403, for a dollar of equity, they got $34.03 of assets. That's a way to look at that, which means they've got $3 of debt, right? 727 for $7.27 of assets, they have a dollar of equity and 627 in debt. A lot of debt. It had been a lot lower before that Hey Dudes acquisition. So it looks like they ramped up their debt a good bit to help finance the acquisition of Hey Dudes. And this multiplier has been drawing down, less debt, but it's still pretty high. So Crocs is fairly heavily financially levered. Now, that magnifies returns. See what's happened to their ROEs. Return 400%, 130, 70%, pretty huge, but they're getting it because of all this financial leverage right here. All right. So what would happen if Crocs suddenly started losing money? These would be really negative in a hurry. So there's a pro and con to using a lot of debt. A lot of debt will make your earnings more erratic, and if they lose money, they will lose a lot more than if they had less debt. So we can see a few things pretty quickly up here with them. Sorry, Trent. Now, something else I would look at to get a little bit of a view after looking at this DuPont analysis is, now this is like I say, like companies like Caterpillar or Crocs. So either they manufacture something or they hold inventories. Now I know Crocs manufactures as well, but they also both hold substantial inventory. So you could look here in the turnover analysis, but let's go up to a different tab. Let's go to key items and go to asset quality. And in here, we'll find the following. So you'll have turnover ratios, but I think the better way of looking at this is days. So what this is showing me right here, days inventory on hand. So let's see what's been happening in the past several years. Crocs has gone from just under 78 days of inventory on hand to just under 88 days. So their inventory's gone up. Is that good or bad? Well,
It's good.
if,
Good,
how so?
because they're preparing to sell more.
It could, that's a possible explanation. What's another explanation?
They can't
They're
not
selling.
selling.
Right? So you got a good and bad here. Either they're
planning.
gearing up for expected sales, or
It is taken
they
in
have
December.
geared up and it's just not, it's not selling like they thought it would.
But it's taken in December.
But they're all
every
taken
year.
in December.
Let's see where they are now. Let's
Say
look at
quarters.
fiscal years and quarters.
Quarters will tell you what they're preparing for, or if they're not preparing. Happenstance.
Look at a recession and then go off of that.
Oh, look at that. It's okay. Going down.
It's
Eh,
down slightly, right? So it's come down the past several quarters for them. They started to trend down their inventory. So day sales outstanding, so credit. So when they sell something, they sell it on an IOU on credit. This is how long it's taking them to get that money back.
36 days?
That's crazy.
Yep. So let's see. I'm kind of curious. Let's look at Caterpillar instead of Crocs for a minute. Let's see what they've got going on. We'll do the same thing. Let's go to the key items.
Oh, wow, that's a lot.
Now, but what kind of items do they have though?
Big items. So.
All right, so they've got expensive industrial equipment. as opposed to shoes. So I'm not surprised that Caterpillar has a lot longer day sales outstanding, right? Accounts receivable credit they've extended to their customers.
Should I be concerned if a makeup company is up in the 150s?
If what company?
A makeup company?
We'll look at them in a minute.
How fancy is their makeup?
They kind of blew up. I'm looking at them as he goes through different things to look at, but
But I don't see a whole lot. I see it trending up a little bit, but not hugely, right? So I'm not seeing a big spike up there. Let me show you guys an example of something that would be, say, concerning. So we've seen these either come up in reports or they've been here in Roundtable in the past. So Scott's Miracle Grow. Let's bring them up. The start of the pandemic, everybody was homebound, so everybody decided to start gardening.
Oh.
And let's see, let's bring this up to, let's just do fiscal year so we can see year by year. Okay, so here is their days inventory on hand, about 76 in September of 2020. And then Scott's is selling lots of stuff, so they start ramping up production. And then by September 2022, people decided they've had enough of gardening. So Scott's is seeing their inventory just balloon on them. And it took them a while to liquidate that, right? So that, if we look back at their stock price, it went down during those years when that was happening. You can also see their day sales outstanding ballooned out as well. Let's see, let's go look at another here real quick.
iPhone 15. Big bust.
man, they've only got 10 days of inventory on hand. That's a
It's
lot.
really low, yeah.
It is low, but look what they've consistently been over time.
They've been low.
So, 8.7, 9.1, 11.81.
They're in there.
Right, so it's kind of is ballooned up for Apple this time around,
It's like 25.
which is odd because I thought they were selling a lot, right? Wasn't they were?
Their phones are
Christmas is
being
around
less
the
bought.
corner?
Samsung is
that?
exploding.
Are you
think that it's
just
'cause
fighting for the
Christmas is
Samsung
around the
right now?
corner, so
Dude,
they're
nobody's
probably
buying it.
stocking up
I mean, how
Right.
does
It
Samsung
could
stock
be,
do?
but
Do
that's
they have,
something you
like, a
want to read on,
decreasing
right?
days of
So,
They're
inventory?
mature.
So
Now,
It's just flat.
notice something interesting about. So you've got days inventory, right? So basically, they run out of their inventory within about 12 days. Days sales outstanding, so the credit they've extended about another 59 days. You add those together, you've got what, 71 roughly?
Yeah.
71. So they pay, or you can say they get their inventory, they build their phone, they sell it, they collect cash about 71 days. And then what? When they're delivered inventory, they're probably given an IOU or a bill, right? And they've got to pay it within a certain period of time. How long is Apple taking to pay?
That's a good amount of time.
Oh, it's going up.
About 114 days.
Balancing
they're
that
taking.
ratio, huh?
So they're taking longer to pay their suppliers than what it takes Apple to take those supplies, build a product, sell it, and get cash.
Sounds like aren't they notorious for like paying really late on stuff?
Yeah. So
Interesting.
basically, you see the negative right here. That is, they're getting cash before they have to turn back around and pay their suppliers
That's good.
for about 42 days, which means that money they can put back to use. Whereas if we had, now we'll come back to Apple here in a second.
What does
If
that
we
mean
go-
one more time? The net operating cycle?
Oh, it's how many?
Days inventory, so we've gotten our inventory,
Uh-huh.
plus day sales outstanding, credit sell, collecting cash finally. So add those two, that's how long it takes to collect cash, right, on your sale.
Mm-hmm.
Roughly 71 days. Minus days payable, 114. That's how long it's taking Apple to pay their suppliers. So this is basically looking at cash. You could say cash flow from working capital. And when this is, let's look at another company real quick. Let's look back at Crocs real quick. Crocs is much more typical. So their net operating cycle here is 65 days. It had been up in the 70s, right? They've dropped it down. They've dropped it down because while their inventory is still kind of high, it's come down from what it was in 20 and 19. They're collecting on sales a little bit quicker, and they're also taking a bit more time to pay their vendors, their suppliers. So it's taking Crocs about 2 months to pay, or they've got about 65 days there in which they're having to, between the time they have to pay cash and the time they receive cash. What does that mean?
Good. Well,
I receive cash, or I pay cash to my suppliers, and then about 2 months later, I receive cash from my customers.
You
to
probably
pay up
don't
front
have enough
and-
to sustain yourself from that time to that time. You have no, like...
Or you've got to finance it somehow, right?
Yeah.
you gotta
So
be smart.
when that net operating cycle gets larger, then that's more time that the company has to find a way to finance that working capital. So it adds to their cost,
So Apple's being negative is a good thing?
Yes.
because it means the exact opposite. It basically means that vendors are supplying them with more capital than they need for working capital.
They must have a lot of power over those
Yeah.
suppliers.
Who was? What company were you looking at?
Elf?
Oh, them. Okay. ELF.
Yeah.
Okay.
Oh, them doesn't sound very.
Well, we've had them in here before.
Oh, interesting.
Remember last semester we were talking about them, and all
Yeah.
those little girls were going into the stores and stealing stuff and running out?
Oh, that's
So
brutal.
they had to
Was
put
that them or Ultra?
That
or Ultra?
oh, maybe that was Ulta.
Okay.
Oh.
It was one of those.
That is one of them.
That's a long time
Um,
of inventory.
So ELF, let's see, days inventory.
It's awful
so
long.
it has increased some, hasn't it?
They do it March. That's interesting.
Their day sales outstanding it's dropped some over the years.
I've got it going all the way back to 15, and in 18 it says that they were at, not 18, 17, it says they were at 230. I don't know what happened there. Something bad, I guess.
Oh, you mean for this operating cycle here?
Yeah. Ooh.
Now remember, that's how long it's taking them to get cash right here. But subtract out days payables, and that's telling you how long they have to finance everything. So it's this last number down here.
So they really
So would you want that to
They
be
really
positive or
like
negative? It doesn't.
Well, there's going to be very few firms that are like Apple.
Yeah.
What I'd be concerned is that this number is starting to balloon upwards, right? So what if we were going in time this way, right? And it had been like 138, 137, 165. That would be a matter of concern.
So
Tim.
what made Apple so unique that they have so little on hand and they can pay it back so slowly?
Let's think about, so Apple's kind of interesting. Apple's huge, right?
Yeah.
Don't they have a ton of
And
like cash?
so they've got, it's not so much that that's driving it, it's they end up with suppliers who, if they lose Apple as a customer, it puts them either out of business or in bad financial shape. So Apple has a lot of market power over its suppliers. And they can get away with taking that market power and dragging out the time they take to pay those vendors. They can drag it out substantially. You can see here. Now that's dragging it out quite a lot over what they had. That might be causing some friction with their suppliers. So that'd be worth investigating and to see if even Apple has kind of gotten too aggressive with that.
Oh, what Samsung's look like.
I imagine they're reacting to their increasing days on inventory on hand, but they have an increase in that. They're trying to increase the other one within the question is
Yeah, but they've really
Yeah.
98 to 114.
they're taking advantage of it.
It's quite odd.
Too much.
Samsung is like the
I don't know why they
opposite.
could do that.
That's interesting.
Let's look at one other. So let's see. Let's look at Ford real quick. Who's got Ford? Who's got the auto manufacturers? Is that you, Laura?
Yeah, I think Ford is on the
Okay.
discussion.
So inventory, cars they're selling or not selling. If we put up Stellantis up here, I think we'd see some pretty bad numbers from all the news I've seen about them. But let's do them real quick. Stellantis.
It's Stellantis. Come on, Sam.
What kind of car is
But are
that?
they? That's Chrysler.
Oh, that's Chrysler? I was gonna say, I've never heard of that car.
Multinational.
Well, that's the company that owns them.
Yeah.
So
They own quite a bit.
yeah, you can see Alfa Romeo, Chrysler, Dodge,
So, they own Chrysler.
Jeep.
Dodge.
all the vehicles that go into the repair shop all the time.
I was gonna say, those are all of the cheapest names like out
There you
there.
go. There you go. So you can see what's happened to their days on hand. Their inventory has ballooned up a little bit. They're taking longer to collect cash. In turn, they're trying to stretch out payables more, so they kind of have a slight negative right here. All right.
So would that be a bad sign since it's going up technically?
These right here.
The
Yeah.
operating cycle.
Yes. Yeah, I'd rather see the operating cycle at least be steady or come down than go up. Absolutely. Now, some of you are not going to have to worry about inventory, like utility companies, right? That said, let's see, like Duke, for example. So when you're doing this, think about what your company is. If it manufactures something, you know, like an industrial firm, or it holds substantial inventory like a retail firm, then inventories, that operating cycle are going to be important, right? So Elf Beauty, for example, many of the staples firms. But it may be like, you know, a company in the energy sector or the utility sector, that's just not going to be important for them. I suspect most of your companies, Trent, it's just not going to matter for them, right? So Google makes its money from advertising. So inventory is not going to matter with those companies at all. Instead, for companies where inventory just doesn't matter, we have to see what they've got for inventory.
Batteries.
Electric supply.
I don't know.
Yeah, I want to know.
Well, I can tell you banks don't even have that
Oil
page
on
at
hand.
all. So.
Yeah,
I say
yeah.
banks are just ratios and ratios. They got the
Now,
ratios.
what about a company that doesn't really have any inventory? Then I would just look at basic asset turnover and fixed asset turnover and see what's happening with them. Sales to assets, sales to fixed assets.
And you just want it to be mostly stable?
Stable or increasing.
What if they don't have data every time?
So a healthcare company,
Elements
Yes.
Health.
I know real estate doesn't have any.
I don't imagine real estate doesn't have inventory. Unless they're one of those making home places, but I don't know if they would count as real estate. You know what I'm talking
One of
about?
those shipping
Okay.
container home places
Yeah.
that keeps houses on hand.
yeah, so for them, Pat, let's do this. Let's go down to just basic ratio analysis instead. Now, I don't know why they did that in key items. So in key items, asset turnover analysis, it's blank, but if you come down to ratio analysis, they actually do have some of that data.
Oh.
So many of your companies shouldn't have anything in the way of inventory that we're interested in. But they're still going to generate sales. They still have assets. So asset turnover, fixed asset turnover, we can still utilize those as measures of efficiency for them. Right? So in other words, if they're making something or they might hold inventory or stocks, look at those working capital measures, right? So days inventory, things like that. If they don't, regular fixed asset turnover, total asset turnover.
Could you explain what it would mean? So you said it would be better to see them stable or increasing. Could you explain what it would mean if it was decreasing?
Which company?
I'm looking at TDS is the ticker, telephone and data systems. It's just decreasing a little bit.
Just the basic asset turnovers?
Yeah.
Okay, so, and real quick, if you're ever uncertain, click on the numbers and it will show you how they're computing it, right? So it'll give you the ratios, so sales to assets on there. So that tells me what I need to know right there. Even if I had never seen that ratio, I know I'd rather see more sales for dollar of assets than less. And this is decreasing. In fact, it's been pretty steadily decreasing over this time period. So for their assets, they're generating less sales. Even for their fixed assets, it's still trending down. So they're not generating the sales they had before. So again, if we looked at them and say looked at their growth, right, they haven't been. They've been actually getting a bit smaller, haven't they? Less sales. That tells me part of the reason why those turnovers have gotten worse. They've got the assets they've had, but they're generating less sales. Their sales have been declining. So that's led to deteriorating turnover ratios. That'll do it right there. Let's see. Real quick, if I were, let's see. Let me show you guys this. So let's get away from the ratios real quick. Now to do this next thing, you're going to have to go log in through MySFA, whether you're on campus or off campus. But there's the site IBIS World, right? So just type into your search bar IBIS World, all one word. It'll bring you to the site. Again, log into MySFA first. Then bring this up, click the login, and it should detect that you're logged into SFA, and SFA is a subscriber. And so it'll bring this up. Eventually.
They gotta be doing something in there. What are they doing there?
I don't know. They're like a bad neighbor.
Like watching a Disney movie.
Who never knows when to shut up. Right downstairs.
They pull out one of those big VHS tape players with
There
those
we go.
TVs and
I
slide
think
in
it's
the
one of those
VHS tape.
classes where the professor only
Okay.
shows like
So,
movies.
there are a couple ways to use this, but here's probably the easiest way. You've got a company that you're researching. So, for example, like Duke. So bring up Duke. Just put in the search bar, bring it up, and it will. Well, let me do that again real quick. Come on. And maybe what I want to.
What are you looking for?
Okay, so it brought me up a report on Duke itself, and then below that you'll see utilities in the U.S. So they're two separate reports, but there's a lot of common elements to them. That's looking at the utility sector, of which Duke is listed in there, right? So I can look at that, or I can simply bring up this on Duke itself. Like I say, it shouldn't really matter. It'll be a lot of common elements to them. So what's the benefit of going through this? It'll give you a bit of overview analysis about the company. They're kind of like Standard & Poor's. IBIS World does a lot. They've got financial analysts. They do a lot of company research. So it's like, like the credit default swaps. The market's kind of already done some research. It's like Standard & Poor's, they've already done some research. IBIS World has as well. So it's a convenient way of taking what their analysts have said or seeing what their analysts are saying about a company. So basic overview, but inside of here, there will be, here we go. So looking at this industry or this sector, we kind of get some basic idea of how they stack up for Duke. Right, so they're basically saying, let's see, performance, so I suspect annualized change, that must be by revenue growth. Moderate, so they're growing, but they're not growing super fast in that sector. Profitability strong, so they're saying basically they are stronger than, they're looking at 5 competitors on here, so they're the strongest out of them. You get a little bit of an overview. Productivity, that's those turnover ratios we were looking at, so they're not particularly good in terms of their asset turnover. So they've got, you could say, more of their assets are idle at Duke than most of their competition, and that's expensive. Coverage, ability to pay interest on debt, liquidity, being able to meet their short-term payments is weak. And then down here, here we go. Let me bring it back up here, guys. They'll tell you about the competitive environment that Duke's in. They'll also tell you about competitive analysis. So, you know, is Duke in a position where it has a competitive advantage or any kind of advantage at all? Some of these you're going to find, like in utilities, there may not be many of them that do. Right? In utilities, they're not going to have a lot of pricing power, but some utilities will have what they call scale, where they have lower cost per unit. And that makes them relatively more efficient than their competition. Same thing for energy. Same thing for materials. Whereas on, you know, for discretionary or communication or tech, they will have, if they have a competitive advantage, it will almost certainly be in regard to being able to price their product at a higher price. So they're not looking to lower cost, they're looking to build in features that give them pricing power. And so IBIS has done a good job at describing that up here. Right, so IBIS will give you a good assessment of, does this firm have a competitive advantage? And if so, where? Right? And is that competitive advantage, is it fairly stable? Has it been eroding? Or are they actually building it up, even making it stronger? So it's basic things you guys have had in intermediate, like barriers to entry, power over suppliers, which I guarantee that's what Apple has, where they've been stretching out those accounts payable. Power over customers, amount of competition, so the lack of helps them out, and then substitutes for them. So for example, well, let's see. Right, so I wouldn't read through all of it, but they'll give you a basic view or an idea what you should expect. So in other words, if I were to read that first and then go look at the ratios, I would know what I would expect to see from the ratios, and then maybe the ratios don't look that good anymore, then there's a problem with the company. Let's see, what else is up here? Okay, so basic competitive analysis, I go to that right there. Let me show you guys one more thing. We'll do a few more things on Thursday. Let's just look at one more thing here. What do I want? Okay. We'll look at, so let's see, this part right here, management discussion and analysis. I've mentioned this a couple of times. Definitely look through a most recent report. You don't need to read through it, but just scan through it. There's a section in every 10K called the management discussion analysis. Literally, it'll be in there exactly like that. In the early part of it, they will list out what they think are their, you could say, their opportunities and their risk that, or any kind of issues that they face. So pay attention to that. Maybe it is they're worried about rising interest rates might affect their balance sheet, for example. All right, or maybe political pressure on traditional utilities or fossil fuels, right? And that would be spelled out in that, and they would give you a good idea of how severe they think those risks are, or what opportunities they think they have. So there'll be a lot in there. Also, if you're looking through the ratios first, which I would do that first, and for example, you see inventory build up like with Crocs, I would look through and see if they make any statements about inventory building up and what kind of issues they see in there. So look at the ratios real quick and then kind of look at the MD&A and see what they say in there. We'll do a few more things. I don't want to throw a whole lot more at you guys, but we'll look at a few more things in fact set on Thursday to wrap this up, okay? May look at a couple of specific companies in here and see what we find, right? I will, so if you guys are still working your screens, I'll be here all tomorrow. Come by and see me. And if not tomorrow, then Thursday. Sooner the better though, so you can move from that to looking at specific companies, right? And do that. Ethan, you got a few more minutes?
I do.
Because your sector is so different from all the rest.
So it's gonna be a lot of bank analysis.
Yeah.
Gather.